Hello, it's Saturday evening, October 19th, 2024. Welcome to Chart Built Wealth, profitable investing with technical analysis. I wanted to do a quick review of my current buy recommendations. Would like to start doing the review on the weekend when the markets are silent and you and I have a chance to digest things. The theme here is the potential for commodities to be the asset class of choice, such as they were in the 70s. They are under-owned currently. However, oil, the gorilla in the room, has to break out. Until then, we will just buy patterns based on their own merit and not as a group. So let's get into it. Crude oil in the commodity space after a promising bounce off a confluence of moving averages. Here it is with a bullish hammer, which suggested we have a higher high. Um, I said our stop was at 70. And with a significant break, say below 69, I would be stopped out. Well, here's what happened. We have a significant break down to 68, 69, so I will reluctantly go to a neutral rating. However, most oil stocks are still holding support and have point and figure buys. Things I recommended, like Marathon Oil, the Energy Spider ETF XLE. Longer term, let's take a look at the chart of crude oil. This is a big picture, a big 3-year descending triangle. Support is 65. So in the big scheme of things, 65 is a critical support for crude. Will it hold? If I knew for sure, I would hold my current recommendation. If I did, the risk would only be 6 or 7% downside, with the potential upside being enormous. However, I'll follow my discipline and go to neutral. Uh, if we get, a bullish hammer that comes down to 65 and bounces off similar to what we had here a month ago, then I would reinstate my buy recommendation. If it then breaks 65, I will sell. And if the energy stocks begin to break their point and figure trend lines also, then I'll let go, put my tail between my legs and crawl off into the corner. I don't think that's going to happen. Here's Marathon Oil, the big symmetrical triangle, the breakout, and the consolidation since then. My stop is at 25. Everything looks fine there. The point and figure chart is saying we're challenging our bullish trend line currently and we're hanging on by a thread. So I'll be watching this carefully. XLE, the Spiders Energy ETF, down 2.66 on the week. Buy recommendation was made on October 7th at 91.07. We're currently at 90.34, so down a little bit. Stop is way down at 86. I've been buying this pretty aggressively. As I said on the last update, I've been adding to energy stocks more than crude oil because the heightened volatility of crude oil. FXI, the iShares China large cap ETF, tends to move in tandem with energy. On Tuesday, I said I'd been selling on the up move and buying more on each down day. So these 3 up weeks, selling, 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 and I can buy these back at lower prices. This was the chart 3 days ago. And this is how the week ended. Well, FXI went a bit lower on Thursday, and then Friday had a big up day, bouncing off the neckline. Here's the neckline, forming a bullish hammer. Here's a bullish hammer. The down week was marked by less selling over here, which is bullish. Everything looks pretty good. A lot of volatility, though. Prices start to trend higher. I'll move my stop up from that is 24-ish up to around 30. Protect the money that we made. But everything looks good. Alibaba, BABA is the same situation as FXI. We got extremely overbought up here, selling on the huge spike up in September has now allowed me to purchase more. There is still a lot of potential upside with a price projection of 150. I've been adding this week. Platinum, the Platinum ETF, PPLT, falls within our commodity theme. Gold, silver, copper, etc. Platinum is underowned and sentiment is not anywhere near as bullish as on gold and silver, which have already moved. I like to buy things before the investment community latches on, a la China. When I initiated with a buy rating on October 1st, I suggested that platinum may be forming a right shoulder over here on a small 4 month inverse head and shoulders pattern, bullish inverse head and shoulders pattern. If prices get above 93, this small pattern suggests a 104 price projection, which doesn't sound like a ton of upside. I hope you sold a few shares anyway. We were up a couple of percent this week. But if we look at the bigger picture before if you look at the bigger picture, 104 would break us out of this large 3 year symmetrical triangle. We had a bullish hammer last week. Our stop is about 85, but if prices can get up to about 100, this pattern will become intact and suggest 144. So that smaller pattern would dwarf into this larger pattern, which from here is about 60% higher. Again, our commodity theme, but not gold, but the gold miners ETF, GDX. Gold miners carry the added risk of market risk. The correlation between gold and the market is low. The correlation with the gold miners and the S&P is more aligned to each other. If the market goes down, gold miners probably go down. Market goes up, gold miners probably go up more than gold. So there's added risk. The big 4 year inverse head and shoulders pattern that broke out on April 25th at 34.33. That was the day of my buy recommendation. The price projection is 50. Everything is still intact. We had a big up week, up almost 8%. You should have been selling during the week. The everything's intact, but the negative here is there is a bearish divergence, at least so far. So as prices have hit higher highs, our relative strength index is hitting lower highs, suggesting that the underlying demand is weakening. Maybe the smart money is starting to take some of their money out, and all these CNBC chasers are starting to buy. But it looks good, still looks good. REITs outside of the commodity sphere provide lower volatility, good dividends, bullish 2 year inverse head and shoulders pattern, left shoulder, head, right shoulder. Had a small inverse head and shoulders pattern back here that I was able to buy in June. And after selling on these up weeks, the last few weeks is the first chance to buy some of those shares back. And so that's what I was doing. Everything looks fine here. National Retail Properties, NNN, another REIT, had over a 5% yield when I purchased it back here. Again, the same pattern, inverse head and shoulders pattern. Price projection of 52. Things look fine. We get a little bit of a negative divergence so far, but this has been a strong performer. Another REIT, American Homes for Rent, AMH, purchased with the other REITs on this breakout. It failed. It came down. It gave me a chance to add, which I did on our YouTube broadcast, suggesting buying on this weakness down by our stop. Had a big spike up. You wanted to be selling, and now you wanted to be buying. So I've started to add back to AMH. Fixed income. Did a quick update on this. I don't think it was very complete. So I want to uh, clarify a few things. Went bullish on May 20th at 91.12 on TLT, the 20-year ETF. TLT, the multi-year bullish inverse head and shoulders pattern, left shoulder head, right shoulder, suggests a price projection way up at 115. We recently had a pullback. I went to a neutral rating and I have been slow to add here because of overhead resistance. So let's just take a short-term look here. This is kind of like crude oil. The big pattern's still intact, but we have some short-term confusion. And the 6-month chart of the 20-year Treasury ETF TLT had a rainbow convergence. Here you see the convergence. Prices came back to that convergence, were unable to break through. It promises a new low. Oops, I'm sorry. Go back. Go back. There we go. Promises a new low. Maybe we test the 90 stop level that we had on the larger chart. But when I went to a bullish rating on the 20-year Treasury back in May, I said this was a counter trend move upward. The long-term Treasury bond had been in a downtrend for several years, so I needed to react before we get to a long-term confirmation that the next down leg in Treasury prices and uptrend in yields has reasserted itself. So we'll see. I'm going to be watching this closely, just like crude oil. The newest buy recommendation was the iShares NASDAQ Biotechnology ETF IBB. The big 2-year ascending triangle broke out on June of 2024 and has been in a consolidation. Our potential upside is approximately 20% higher, and our stop is 137.5. Everything is still intact.